Welcome to the deep dive. We have a genuinely mind-bending premise for you today.
We really do.
Yeah. I want you to think about this scenario. How does a blocked shipping lane in the Middle East mathematically guarantee a massive upgrade to the underlying code of the entire global financial system?
Right. I mean, it sounds like this setup to some kind of geopolitical thriller.
It does.
But when you strip away all the noise and look at the actual plumbing of global finance, it is a very real, very measurable chain reaction.
And today we are going to trace that exact chain reaction for you. We are pulling from a really fascinating stack of sources.
The big stack.
Yeah, we've got geopolitical risk reports, we have press releases straight from the CFTC, and some seriously deep-in-the-weeds technical white papers covering everything from the XRP ledger to Ripple's digital prime broker model.
The heavy reading.
Exactly. Our mission today is to connect the dots from the Strait of Hormuz all the way to a $3 trillion global margin call, and reveal how this exact type of crisis is the catalyst for overhauling how global banking actually works. Okay, let's unpack this. How do we even begin to get from a physical shipping lane to a digital financial system upgrade?
Well, the core theme you have to keep in mind is that financial crises are rarely just pure chaos.
Okay.
If you look historically, crises are actually mechanisms. They are these forced pressure tests that compel legacy systems to admit defeat and adopt new technology.
So it's not just random panic.
Exactly. What you are witnessing in the macro environment right now, the panic headlines, the market volatility, it is rarely what it appears to be on the surface.
So let's start with the physical trigger mentioned in our risk reports. The Strait of Hormuz.
Right, the choke point.
Yeah, for those who might just view it as a spot on a map, this one choke point carries about 20% of global seaborne oil.
20%.
A disruption there doesn't just mean higher gas prices for us. It means an immediate systemic oil shock. And the country most vulnerable to that shock, Japan.
Yes.
Why is Japan the domino that matters here?
Well, Japan's exposure is uniquely severe compared to other developed nations.
Yeah.
I mean, they import roughly 95% of their oil from the Middle East.
Wow.
And about 70% of that moves directly through Hormuz.
So they are completely dependent.
You are looking at an economic powerhouse that is fundamentally dependent on imported energy just to keep its lights on and its factories running.
The math from our macro reports really puts this into perspective. Because oil is universally priced in US dollars, you can't just look at the raw price of a barrel.
Right, you have to factor in the currency exchange.
Exactly. You have to look at the oil in yen shock. Before the recent geopolitical disruptions, using late February conditions, Japan's imported oil burden was about 10,931 yen per barrel.
Right.
In a matter of days, with oil prices spiking and the yen concurrently under pressure, that cost jumped to 14,629 yen per barrel.
That is massive.
It's a 34% spike in their national energy bill almost overnight.
And what's fascinating here is the impossible dilemma this creates for the Bank of Japan, the BOJ.
Because of the exchange rate?
Exactly. The exchange rate for the US dollar to the yen has been hovering dangerously close to 160.
And 160 is the magic number.
Yes, Reuters and other financial outlets note that 160 is widely treated as Japan's line in the sand for market intervention.
Right.
So the Bank of Japan is effectively backed into a corner by this oil shock. To stop their currency from bleeding value and making those energy imports impossibly expensive, they are forced to consider raising domestic interest rates.
But raising rates during a global economic shock risks crushing their own domestic economy, right?
Absolutely.
It makes borrowing more expensive for everyday Japanese citizens and businesses.
That is the tightrope they are walking. They have to defend the currency, but doing so could trigger a recession at home.
Now, if you are listening to this, you might be asking yourself, why should I care about Japan's energy bill or their domestic interest rates?
Right. How does it affect my portfolio?
Exactly. Well, Japan happens to be the world's largest net creditor nation. Their money is actively funding the global assets you likely own right now in your retirement account or your personal portfolio.
It's all connected.
Which brings us to a $3 trillion elephant in the room. I keep seeing this phrase, yen carry trade, scatter throughout these macro reports. Can you break down the mechanics of this for us? How does Japan's interest rate dilemma connect back to global markets?
Yeah, the yen carry trade is one of the few macroeconomic mechanisms capable of triggering a sudden, violent liquidity shift across all global markets simultaneously.
A violent shift.
It really is. The mechanics are relatively straightforward but massive in scale. For years, investors have been able to borrow money in Japan at near zero interest rates, historically between 0 and 1%.
So it is essentially like taking out a 0% interest credit card.
Basically.
You take that essentially free Japanese yen, convert it into US dollars, and buy high-yield global assets. We're talking US treasuries, massive tech stocks, hedge fund strategies, maybe even a crypto.
Yeah.
You earn a 5, 7, or 10% yield on those assets, pay back the tiny 1% interest on the yen you borrowed, and pocket the difference.
That is the trade in a nutshell. And our sources estimate there is anywhere from $1 to $3 trillion in global leverage tied up in this exact strategy.
That is an insane amount of leverage.
But that entire machine relies on two fragile pillars: Japanese interest rates staying near zero and the yen staying relatively weak or stable against the dollar.
So if the Bank of Japan is forced by that oil shock to hike rates, the yen suddenly strengthens and that trap snaps shut.
Right. Suddenly, the cheap borrowed money you owe becomes incredibly expensive to pay back. Institutional investors realize they are losing money on the currency exchange rate faster than they are making it on the asset yield.
So they have to get out.
They have to exit the trade.
Yeah.
And how do they do that? They are forced to sell off their global assets.
They dump stocks, they liquidate bonds.
They sell whatever they can to rush back, buy yen, and repay those loans before the currency shift bankrupts them.
This isn't just abstract banking math. When they are forced to sell global assets to pay back those yen loans, they are selling the very tech stocks and index funds sitting in your 401k.
Exactly.
It triggers a global sell-off. And that sudden rush for cash leads us directly into the global repo market.
A core of the plumbing.
Yes. If you aren't familiar with it, the repo market, short for repurchase agreements, is basically the pawn shop of global finance. It is a $10 trillion a day system where banks, hedge funds, and institutions pawn their secure assets, like U.S. treasuries, overnight for cash to meet their daily obligations.
And in a massive carry trade unwind, everybody is rushing to the pawn shop at the exact same time.
And this exposes the fatal flaw in our current financial plumbing. The sources we are reviewing emphasize a massive insight here. The problem in a crisis like this isn't a lack of collateral.
Right, there are plenty of assets in the system.
The problem is collateral mobility.
Collateral mobility.
I love that phrase. Let's dig into that. What does a lack of collateral mobility actually look like in practice?
Think about the legacy banking plumbing. It requires manual reconciliation, fragmented databases, intermediary clearinghouses. Moving a treasury bond from one institution to another to meet an urgent margin call can take hours or even days to officially settle.
And days are a lifetime in a crisis.
Exactly. When the entire global system is stressed and everyone needs cash immediately, that delay is deadly. We saw a preview of this in September 2019 when overnight repo rates unexpectedly jumped from around 2% to above 10%.
Oh, wow.
The collateral was there, but it simply couldn't move fast enough to plug the liquidity holes.
Imagine standing in line at that financial pawn shop with a billion-dollar treasury bond in your hands, desperate for cash to save your fund, but the clerk is using an abacus and telling you to come back in 2 business days.
That is the reality of legacy plumbing.
But here's where it gets really interesting, because a crisis in collateral mobility isn't just a panic, it's an opportunity. That takes us to a concept from the sources called transitional permission.
Yes, a sovereign balance sheet analyst in our stack of research notes that major banking upgrades are never implemented in calm waters. Institutions are inherently bureaucratic. They're risk-averse.
Nobody wants to spend billions of dollars changing the engines while the plane is flying smoothly.
Exactly.
Mm.
But a crisis, a severe liquidity shock, creates transitional permission.
Meaning the sheer terror of the system breaking provides regulators and politicians the justification they need to push through structural change, new oversight, and most importantly, brand new infrastructure.
For years, these massive financial institutions have been quietly researching and piloting alternative settlement architectures in closed environments. Things like real-time liquidity rails and interoperable digital assets.
Right.
But when a liquidity shot hits, like a carry trade unwind breaking the repo market, it takes a typical 10 to 15-year institutional adoption cycle and compresses it into months, or maybe a couple of years.
Timeline compression. And we are actually seeing real-world evidence of this timeline compression right now. I'm looking at a press release here from CFTC Acting Chairman Caroline D. Pham.
Right, the CFTC pilot.
She recently announced the launch of a U.S. digital assets pilot program specifically for tokenized collateral in derivatives markets. They are explicitly targeting the use of assets like Bitcoin, Ether, and USDC as margin collateral.
And look at the justification for doing this now.
Right. Heath Tarbert, the president of Circle, said in the release that enabling near real-time margin settlement will mitigate settlement failure and liquidity squeeze risks.
They are literally building the regulatory guardrails for instant collateral mobility as we speak.
It's happening right now.
If we connect this to the bigger picture, the regulators are officially acknowledging that the legacy system's inability to move assets instantly is a systemic risk. It is vital to understand that they aren't rolling out these pilots to help retail traders speculate on meme coins.
Definitely not.
They are doing it to protect the multi-trillion-dollar derivatives and repo markets from freezing to death.
Which perfectly sets up the proposed solution we found in the stack. We have a highly technical white paper here from Ripple detailing their digital prime broker, or DPB, model.
The DPB model.
And their target is ambitious. They outline a plan to completely kill the exchange-centric crypto model.
It is a fundamental shift in market structure. Right now, retail crypto exchanges act as execution venues, custodians, and credit providers, all rolled into one massive, opaque entity.
A giant silo.
And importantly, they often use client collateral as interest-free working capital. They take your assets and use them to back their own operations.
Wow.
But as the white paper points out, when volatility spikes and things break, like the spectacular collapse we saw with FTX that free capital vanishes, the internal leverage unwinds and the entire market unravels.
Now, I have to play devil's advocate here. Ripple's DPB model proposes acting as a single credit intermediary. Instead of a hedge fund managing 10 different bilateral relationships across multiple exchanges and leaving their collateral scattered everywhere, they face one prime broker. But isn't placing all that power into a single digital prime broker just creating a different kind of centralized point of failure? How is that actually better than the current exchange model?
That is a very valid critique, but the difference lies in the settlement mechanics. The DPB model isn't trying to hold all the assets in a giant silo. It mirrors the mature foreign exchange, or FX markets, by introducing T+1 net settlement.
T+1 net settlement. Okay, let me translate that. If a fund buys 100 Bitcoin and then later sells 80 Bitcoin in the same trading cycle, the broker doesn't move 100 tokens to them and then wait for 80 tokens to be sent back.
Exactly.
They only settle the residual 20 tokens at the end.
And by doing that, the Ripple paper notes this results in an 89% reduction in gross fund movements.
89%.
It drastically reduces the amount of capital that needs to be actively flying around the network, which reduces counterparty risk.
This context actually explains a major strategic move by Ripple that flew under the radar for a lot of casual observers. Their acquisition of the standard prime broker Hidden Road.
That was a huge acquisition.
It wasn't about them wanting to launch a new app for retail day trading. It was about controlling the prime broker choke points. To clarify, for anyone unfamiliar, we're talking about controlling margin, collateral, and rehypothecation.
Rehypothecation.
Which is basically when a bank or broker takes the collateral you gave them and uses it to back their own separate trades. That is where the real leverage and the real money moves in global markets.
And this is where the XRP ledger, the XRPL, fits into the broader architecture as the settlement bridge. Unlike Bitcoin, the XRPL doesn't use energy-intensive mining. It uses a federated consensus mechanism.
Right.
It is highly energy efficient, and crucially for collateral mobility, it settles transactions in 3 to 5 seconds.
3 to 5 seconds compared to days. So when you pair that 3 to 5 second settlement time with Ripple's upcoming stablecoin, RLUSD, you get the instant liquidity routing required to move tokenized collateral between global markets before a margin cascade can wipe out a fund.
Precisely. RLUSD provides the stable, predictable dollar value, while XRP provides the neutral bridge for cross-currency or cross-asset routing without institutions needing to park pre-funded accounts all over the globe.
We are already seeing live institutional experiments of this infrastructure, too. Look at the recent data from SBI Holdings in Japan.
Yes, SBI is a great example.
They're issuing yen-denominated on-chain security token bonds. These bonds pay a normal fixed interest rate, around 1.85 to 2.45%. But they also distribute an XRP benefit to the bondholders over time.
And to be clear, our sources emphasize this is not some marketing gimmick to pump the price of a token.
Not at all.
It is what financial analysts are calling synthetic FX optionality. Let's break that down. Japan has persistent excess yen liquidity. By distributing XRP to these institutional bondholders, SPI is quietly placing a highly liquid, neutral settlement asset directly onto institutional balance sheets.
Just sneaking it in there.
And they're doing it without triggering any foreign exchange conversion friction or waiting on SWIFT network delays.
Yeah.
It essentially a portable liquidity voucher.
A liquidity voucher.
If the yen carry trade unwinds, the repo market panics, and traditional FX markets freeze, the institutions holding this pre-positioned compliant bridge asset will be the ones able to move their collateral instantly and survive the squeeze.
It is literal pre-positioning for the exact geopolitical and economic crisis we talked about at the very beginning of this deep dive. That is incredible.
It's all connected.
But this brings us to what I think is the biggest aha moment in our entire stack of research. It's a concept called the velocity paradox and float compression.
This is where we have to look at the mathematical formula that defines how value moves through this new infrastructure. The price of a settlement asset is determined by the settlement liquidity equation. Price equals transaction value divided by the product of float and velocity.
Let me break those terms down so we can visualize this. Transaction value is the total economic weight being routed through the network, like that massive $10 trillion daily repo market we discussed.
Right.
Float is the actual liquid supply of the token available for use on the open market. And velocity is how often each individual token changes hands in a specific time frame. Now, if you spend any time on crypto Twitter or retail forums, the assumption is always that the network needs to move faster. Everyone thinks high velocity is the key to a token being valuable. Why does the math suggest the exact opposite?
This raises an important question, and it's the counterintuitive truth about institutional assets. In retail payment networks, high velocity is normal.
Like buying a coffee.
Exactly. A single digital dollar might be used to buy a coffee, pay a vendor, and pay a distributor, recycling hundreds of times a day. But institutional settlement assets don't behave like cash in a wallet. They behave like collateral in a vault.
Oh, wow. So as these tokens get adopted as native margin collateral by the big players, they get parked.
They sit dormant.
They sit dormant in clearinghouses, backing up derivatives trades. They get locked up in Basel III regulatory liquidity buffers,
The Basel III rules.
which are the strict rules requiring banks to hold massive piles of high-quality liquid assets just in case of a stress event.
And we cannot forget the impact of the ETFs. Massive institutional accumulation through exchange-traded funds, like those launched by Franklin Templeton and 21 Shares, effectively vacuums those assets off the open market, removes them from the liquid float, and locks them in long-term cold custody vaults.
So what does this all mean for the architecture? Let's run the math together. We have the $10 trillion daily repo market and the multi-trillion-dollar derivatives market slowly moving on-chain. That means the numerator, the transaction value, explodes. At the exact same time, tokens are getting parked in margin vaults and Basel III buffers, meaning the velocity drops. And those ETFs are locking up the circulating supply, meaning the float shrinks.
The repricing mechanism here is purely structural. It has nothing to do with sentiment.
It's just math.
Exactly. If the required transaction value going through the system goes through the roof, while both the usable float and the velocity of that float go down,
Yeah,
the mathematical equation dictates only one possible outcome.
the price goes up.
The unit price of the individual settlement asset must adjust upward. It has to, simply to mathematically support the sheer volume of institutional liquidity trying to squeeze through the network. This isn't driven by retail speculation or hype. It is driven by cold, hard, institutional liquidity capacity requirements.
It is a forced mathematical repricing based on the physical limits of the system's plumbing. Okay, let's take a breath and recap the massive journey we've just been on.
It's a lot to take in.
We started with a physical geopolitical choke point at the Strait of Hormuz, which inflates Japan's energy bill. We showed how that creates an oil and yen shock that corners the Bank of Japan, forcing them to consider rate hikes that threaten to snap the $3 trillion yen carry trade.
Which, in turn, threatens to trigger a global sell-off and freeze the $10 trillion global repo market.
Because legacy banking collateral simply isn't mobile enough to handle the panic.
Right.
And that systemic terror is exactly what gives regulators the transitional permission to compress a 10-year tech adoption cycle into just a few months, rolling out real-time settlement rails like Ripple's digital prime broker and the XRP ledger.
And finally, As that massive institutional volume moves on-chain, the undeniable math of float compression and dropping velocity forces those bridge assets to fundamentally reprice.
This is why stepping back and looking at the macro perspective is so invaluable. If you are only watching retail markets, you're probably stressing over daily stock dips or red candles on a token's price chart.
But while the retail market panics over noise, the real players, the sovereign wealth funds, the prime brokers, the central banks, are using that macro stress to quietly lay down the programmable rails of the next century's financial system.
It is a complete paradigm shift happening in plain sight, hidden right there in the boring plumbing of the financial world. And it leaves you with a final provocative thought to mull over on your own.
What's that?
If a multi-trillion-dollar margin call successfully forces the global repo market onto instantaneous, decentralized ledgers, who actually holds the power in this new financial world? Is it the central banks scrambling to issue the stablecoins or the algorithms quietly routing the bridge assets underneath it all?
That is the multi-trillion-dollar question about the future of financial access.
It really is. Thank you for joining us on this deep dive. Keep your eyes on the plumbing, because that's where the real shifts are happening. We'll catch you next time.